Dear colleagues, I'm not sure whether it is provided that we begin. Okay, it is. Yes. Well, our pause was a little bit shorter than perhaps it was previously prepared for by the organizer, but since we have to respect our time frames, my suggestion is that we start with the session. So, dear colleagues, good day to you all. Welcome to the first session of this conference with the topic of corporate social responsibility. My name is Mihaela Braut-Filipovic, and I'm the Associate Professor at the Faculty of Law in Rijeka, Croatia. It is my great privilege to be the moderator of this session today. Before we get started, I will take a few minutes of your time. Regarding the schedule, I have to announce one change. Professor Bistra Boeva shall not be presenting in this session. She will present in the following session, session number 2, after 1 p.m. Today. So this leaves 5 instead of 6 presentations for current session. The order of presentations still remains the same, just without the one from Professor Boeva. Last time I checked, all the presenters are here and I believe ready to start. Regarding the time management, each speaker shall have 15 till maximum 20 minutes for presentation. Discussion regarding the presented topics shall be held at the end of the session. So if you have any questions, just please put them down, write them down in the chat. So at the end of presentation, I hope to have, we shall have a lively discussion. Finally, as to the technicality, please keep your microphone muted while other session speakers are presenting. So let us begin. As we all know, corporate social responsibility is a business model that helps a company be socially accountable to itself, its stakeholders, and to the public. It seems that nowadays there are more than ever challenges to achieve particularly these goals. So it is thus today even more important to hear our session speakers who tackle open issues and pose further questions for considerations. So for the first speaker, I welcome Anne-Marie Weber, Assistant Professor at the Department of Commercial Law, Faculty of Law and Administration, University of Warsaw. Her topic today is towards effective enforcement of sustainability reporting, sustainability auditing, and the role of the new gatekeepers. So please, the floor is yours.
Thank you very much for that introduction. I will try to share my screen and my presentation. If you could just confirm that the presentation is visible.
Yes, yes, it is.
Okay, perfect. Okay, so good morning again to everyone. Today I'm going to present you shortly a fragment of my broader research on sustainability gatekeepers. So the broader project spotlights market actors other than the companies of the real economy, to name a few: financial intermediaries, rating agencies, stock exchanges, or auditors, and asks whether the functioning, the role of these market actors may be able to induce sustainable corporate governance. So my approach largely relies or draws on the literature, one can say the traditional literature on gatekeepers in corporate governance that we know mainly from the Anglo-Saxon countries, and I try to use the theories that were built in that literature and apply them to the sustainability question. So coming from that angle, today I would like to address what is probably most of the pressing but yet least addressed problems regarding the whole discussion of corporate sustainability and sustainable corporate governance, namely the question of enforcement. So why it seems that we are enacting, both the EU and the national legislators, we are enacting a growing number of obligations regarding sustainable corporate conduct. The enforcement and thus the actual efficiency of these regulations remains still very nebulous, which has also been raised today by Professor Konak in his opening keynote speech. So what I aim to signal today in that short time frame is the newly arising issue of sustainability auditing, of course, arising from the newly enacted Corporate Sustainability Reporting Directive. So I would like to explore how this newly introduced mechanism that has not been debated a lot so far. I mean, of course, scholarship and practitioners were and are still mainly focused on the material obligations that stem from the Corporate Sustainability Reporting Directive. So we are largely focusing on the new standards that will be set for the reporting itself. Only yesterday, EFRAG submitted its guidelines on these standards to the EU Commission. So, of course, this is like the hot topic of debate. But I would like to redirect our attention shortly today to another interesting mechanism that is introduced by this directive. So, in order to assess how sustainability auditing that comes into life with the enactment of the CSRD, how it may influence sustainable corporate governance, it makes sense to shortly reflect and maybe critically address the NFRD being the previous regime for non-financial reporting. So although the NFRD, I'm sorry, was for a long time not really identified by the company law scholarship as a tool that influences corporate governance, it should definitely be seen as such. So despite of the fact that the NFRD created obligations that we would systemically place within accounting law, the indirect impact in fostering sustainable corporate governance certainly exists. So the theory behind that is, if I have to report on a certain issue, being here non-financial aspects, at least I have to consider these aspects and take into account the potential reaction of investors if they see what I report on non-financial issues. So not to judge in how far this theory in practice works, at least one can say that this was like the idea of how non-financial reporting influences corporate governance based on the NFRD regime. So if we now contextualize these, this theoretical idea with how the non-financial reporting regime under the NFRD was applied by the market participants in the member states, this positive narrative kind of erodes. Because what was clearly visible was that a clear standard for reporting was lacking, and this is where, of course, the CSRD now steps in. But the other issue that that was raised and visible is that we do not have any, proper quality check or enforcement mechanisms that would be similar to what we have in financial auditing nowadays. So one could say that the NFRD contributed to creating this accountability gap in corporate sustainability that exists between potential obligations and real, enforcement opportunities. So as I said, the CSRD addresses both issues. I will not talk about the first problem here. I think we will still address it in the next thematic session. But as regards the second issue, the European lawmaker tried to address it through what is called the new assurance regime. The new assurance regime is, I'm sorry, the new assurance regime is basically an auditing regime, but for sustainability reporting. So we can, at a very simplified level, we can compare it to what financial auditors do with financial statements. Now we have a regime for performing a similar task, but with the sustainability reports that will be produced under the CSRD. So why, of course, on a simplified level, we can compare financial auditing to sustainability auditing. It actually seems that there will be quite a big challenge in assessing these sustainability reports, because checking whether the numbers add up, which is, maybe I again simplify here, but this is what financial auditors do. It will not be that straightforward with the sustainability auditing, and I think it is clear that that in any case, expertise on the material issues of financial business, of sustainable business conduct will be a prerequisite to perform these reports. The EU, and this has not been, in my opinion, very visible, but when one digs into this, one can see how the accounting and auditing industry was trying to position and lobby itself into that regulation, because the EU, and this is very interesting, is basically creating a market for a new, semi-financial service. The accounting industry, of course, tried to lobby in the direction that only auditors, financial auditors, can perform the task of also auditing the sustainability reports. In the final version of the CSRD, it remains clear that member states may allow other entities, other independent assurance service providers to perform that task. So, so a new market for a new service is being created here. So at first glance, when one tries to assess how the creation of a new category of gatekeepers will influence effective enforcement, or at least if there's a chance of narrowing this huge accountability gap that we have in the whole topic of corporate sustainability, I guess two fundamental channels emerge, and it will, of course, remain open to practitioners and academia to see in what direction this goes. So first of all, we can attribute some contribution in increasing accountability to the gatekeeper function itself that these new service providers, sustainability auditors will provide. So we know from, and this is basically where the whole doctrine also of financial accounting and the thoughts behind why auditing or why auditors are incentivized to perform their tasks in a diligent and proper way. This all will be also applicable to this discussion. So we can basically say that probably the sole fact that the sustainability reports will be subject to auditing, so there will be a third party that will verify the quality of these reports, already contributes to narrowing at least a little bit, right? One cannot expect too much from this mechanism, but at least a little bit, it will narrow the accountability gap. Another important aspect that remains to be observed in this new legal regime is how the sustainability reports themselves, but also importantly, the auditor's opinion on the sustainability reports, how they will feed into the growing trend of climate litigation. So we know that climate litigation, picks on different potential defendants, and there are a lot of different procedural pathways climate litigation can go. But one fundamental problem for the claimants in climate litigation is to gather their let's say their material input into their claims. So they often have problems to get to the data that will inform them on how exactly a company violated some sustainability standard that is being understood as the cause of damage, to put it in simple words. So definitely an auditor's opinion on a sustainability report could be some important input into potential climate litigation. One can also consider that the gatekeepers themselves could be targets of climate litigation, which in turn should also motivate them to perform their tasks diligently. We also know that from financial auditing, there are several examples. Of course, we mostly get to know them if the gatekeeper failed, right? If the gatekeeper failed and we know that there's some investigation going on, that, one of the big fours did not perform their task diligently. But in general, there is the risk of being, the target of litigation themselves. So this should push the new sustainability gatekeepers to perform their tasks in a diligent way. And of course, just to finish with this thought, of course, when we talk about litigation regarding corporate sustainability in general, so irrespective mostly if we talk about civil liability, that has also been voiced today in the keynote speech. Of course, we have the recurring problem of damage. And I think there's still also a lot of work to be done for academia to try to understand the nature of the damage in these claims. But what is important for climate litigation is that sometimes the effect of climate litigation on sustainable corporate governance, it doesn't necessarily rest within a claim that is successful, right? Climate litigation in itself, that the fact that a company is being litigated against, this already is understood more and more as a driving factor for companies to adjust their strategies in a to sustainable practices. So I think one should not overestimate now the problem of really pinpointing the damage, because for most of the NGOs that push that whole climate litigation trend, it is necessarily not so important to win that claim in court, but to have the big, public eye on the litigation itself. So sometimes the end result and the fact if we can establish damage or not is not as important as raising, for example, certain discrepancies between the sustainability report and what the company is claiming about their sustainable behavior in other, let's say, outlets and commercials or their marketing strategy in general. So I encourage those who work on enforcement issues in the area of corporate sustainability to explore this novelty that is the assurance/audit regime in the CSRD. And maybe, as I said, it's not a tool to close the accountability and enforcement gap that certainly burdens the whole corporate sustainability discussion, but at least it could be discussed as a mechanism to narrow this gap. Thank you very much for your attention, and I'm looking forward to any questions or comments.
Professor Weber, thank you very much for your very nice presentation. And now, moving on, for our second speaker, I welcome Jonathan McGowan, an attorney at the McGowan Law Firm in Jacksonville, Florida. His topic today is ESG and fiduciary duty. So please, the floor is yours.
Thank you. As she noted, I'm an attorney in Jacksonville, Florida, which means it's currently 5 a.m. This started at 3 a.m. my time, so I'm a little dragging. But I'm actually going to divert from my topic a little bit. I was going to be speaking on ESG and fiduciary duty in the European Union, which was very well covered in the keynote address. So I have a companion paper that is set to be published next week by the University of Chicago School of Law, and it's dealing with ESG and fiduciary duty in the United States. And that was brought up in the keynote because, Europe is pushing the development of ESG, and the United States is pushing back on it. And I think it might be beneficial to this conversation to understand where that pushback's coming from and what the legal justification of it is. Because as the EU develops these regulations, they're going to impact companies that operate in the US, and it's going to impact US companies. And I think it's important to have that comparative analysis, but bear with me, it's not a prepared presentation. I'm kind of going off the cuff on this, but I think one of the key starting points is to understand why is there pushback in the United States. And it's a political thing right now. It's coming from the Republican Party, which I am a member, but it came from the corporations and the business owners because they felt like it was imposing ideals that didn't necessarily reflect what they wanted to do as business owners. And it was coming from, and it was impacting funds and the fund managers. I'd say when I first started writing on ESG about 2 years ago, well, a couple of years ago, when I would bring up ESG in the United States, nobody knew it existed. It was a term that nobody had heard of it. Fund managers, corporate C-suite executives, business owners, nobody understood the term. It wasn't until about 6 months ago that the term ESG was even used. It's extremely new to us, but in being as such, it's new, and I mean, and we don't know what it is. And that's kind of been a theme, and that's, you'll notice that the theme of the other presentations is it's still so new and it's so developing, and it was pointed out in the one of the keynotes that it is such a fast-moving, developing field. It's still trying to get its feet underneath it and trying to figure out what is ESG, what does it encompass, what does it not encompass, what are the duties that are involved with it, which becomes very problematic for corporate directors and for fund managers. So in the United States, we are definitely struggling with that concept. You are further along. You have reporting standards that are being developed. You have definitions that are being developed. You're not there yet, though. I mean, and I think that is the huge problem. You're still trying to figure out what needs to be reported, how does it need to be reported, how's it going to impact an SME. We have nothing like that. Our Security and Exchange Commission, which is our financial regulatory body at the federal level, just took on this topic in February 2021. That was the first time there was any conversation at a federal level with any regulatory agency introducing any sort of comment on reporting standards. And all they asked of the fund managers was simply that they needed to report what methodology they were using to come up with ESG ratings. Because the ESG ratings that were coming from the fund managers were impacting how corporate executives were supposed to be operating. It was impacting bond ratings for government entities and bond rating and credit ratings for these corporations, but there's no standard for it. And really, the Security Exchange Commission, all they said was, we want you to tell us how you came up with that number. How are you coming up with these figures? What factors are you weighing? But they haven't created a standardization of it. So you're further along there. But that lack of understanding is where the fiduciary duty problem exists. And this is even in Europe, you're imposing a duty on a corporate director that they have to act a certain way, but we don't know what that way is yet. We understand reporting standards. We understand there needs to be a report filed, and that's what's coming out of the EU right now, and then becoming on the state level. Is the reporting is going to happen, but do they have to act? Is reporting sufficient? Does the reporting require a specific action by the corporate directors other than just filing the report? And if they just file the report and they say, we didn't do anything, is that sufficient? And my understanding is probably so. They just need to note that they did the paperwork. And you're going to see that more with the SMEs as they start encountering that. That's going to be their issue. But that starts becoming where the fiduciary duty problem arises. Is there a backdoor way to impose a fiduciary duty to require them to actually impose, say, an environmental protection beyond what is required under local law or jurisdictional requirements? I think one key difference, as you hear the comparison between the United States and the European Union, is we are not a stakeholder jurisdiction. And the stakeholder jurisdiction variances within the EU are going to be problematic as this goes on, like what factors can be weighed in. But in the United States, we're strictly a shareholder jurisdiction. So the pushback is going to be different. In fact, my paper on this for the US argues that ESG for the sake of ESG would be a breach of the shareholder fiduciary, a shareholder primacy for the directors, because ESG funds, ESG actions typically underperform. You're prioritizing an environmental or social issue over finances. In the United States, That's what matters. That's the duty. That's the duty of the fund managers. That's the duty of the corporate directors. One argument that has been made is when you follow the prudent person rule, does that then create a fiduciary duty of these directors? This came out of the UN PRI study, where their argument was, it's interesting, in 2015, PRI came out with their argument that ESG is not a breach of fiduciary duty in stakeholder countries. And then in 2019, they came out and said ESG is a duty under the prudent person rule. And it's an interesting kind of a back way in to create a duty, saying, well, a prudent person would act this way, therefore that's the way these directors need to act. I think ultimately, if that gets challenged, that fails. I can tell you in the United States that would fail. So, I mean, that's kind of where this pushback is developing and where I think it's going to struggle in the US is going to be on the fiduciary duty. I think that what's happening on the political arena, you're going to see different states going to start enacting legislation that will outlaw ESG, or at least outlaw certain ESG considerations. Florida, my state, is probably going to be leading the charge on that. Governor DeSantis, don't know whether that name means anything over there, but he is the guy that's against this. Paul Renner is our Speaker of the House, was sworn in yesterday, and in his keynote speech, he said they were going to take out an ESG in Florida and make sure that these evil Europeans don't tell our companies what to do. And that's the rhetoric that we're hearing, is that it is European values being imposed on American companies. The way they're going to do that, the Attorney General, our chief law enforcement officer, has issued some opinions on it. Our chief financial officer is going to make sure the state doesn't invest in any funds that have that take into consideration any ESG factors. And then will come the legislation, and the legislation will shore up the fiduciary duty issue. Again, and where this ties into what's going on with the EU and its development is you're going to have cross-border transactions. You're going to have companies that operate both, in the US and in Europe. You're going to have companies that funds that cross borders. You're going to deal with a conflict of laws. And that's going to have to be resolved. And that's going to put a real strain on corporate directors when they're having to meet two different standards, that one requires you act a certain way and one requires that you can't act a certain way. Eventually, I think what'll be okay is the reporting standards that are coming out. Those seem to make, I think that'll survive. I mean, you're asking somebody to tell you how they're doing something and what they're doing. That seems to make the most sense. I don't think you'll find any breach of any US fiduciary duty with what's going on with the EU there. Factoring in ESG considerations broadly, it's really going to come down to the environmental thing. It's when we talk about it, we all kind of hone in on a different topic. And that was covered early on, like the E, we focus on the E and the S, we forget about the G. In the United States, it's all about the environmental. That's all we hear about. That's all, when I talk about it, I will talk about environmental. I mean, even if you think about some of the terminology, greenwashing, we're still focused on the environmental side of it. But I think that's where it's really going to, you're going to see your most hangups here. It's if they're doing environmental concerns on top of that are conflicting with what can generate the most revenue, and that's going to be where you'll see the issue. Now, keep in mind, this really only applies to publicly traded companies in the United States. it won't apply to any SMEs or what we would call a small business here. They're privately held. They aren't regulated on this. And of course, you're probably not going to be seeing a lot of transnational issues there, but the pending regulations on SMEs won't be a factor. We're only really focused on funds, investment funds, and we're focused on publicly traded companies where they're shareholders and what are the interests of the shareholders. The one differentiation I had between the keynote and where I was going with my presentation was how do companies address this in the interim? Regulations are coming out. They're being developed. It's a new area of law. How can a company take into consideration these factors and not run into potential fiduciary duty issues? And I think it's going to come down to what he pointed out was the governance. Language in corporate structure that allows the fiduciary, that alters the fiduciary duty to include certain ESG factors would help alleviate that pressure. I think even in the stakeholder countries, that needs to be done while this is being developed, because I think it was Morningstar, I forget what it was, but there was actually a investment fund that Germany went after for greenwashing, and as did one of the states here in the United States. So being able to address this in corporate governance, being able to lay out what the values are, how you're going to address it. And I don't mean like if you go and look at the major corporations, they all have like this ESG page and ESG documents, and it doesn't really say anything. And that gets into the greenwashing problem. The way they need to avoid this is to get in some details and say, look, we have part of the duty of our directors is to meet these standards. And that makes it clear for the shareholders, and that avoids that problem going forward. Yeah, I think, sorry, I know that was not quite what we were expecting. As I said, he covered my topic, and I really, but with the conflict and with what's going on, and this is a international issue, and the pushback over here is going to end up being influencing what happens over there. And I'm optimistic that what I just presented will help give a better understanding as y'all are looking at it as to why, like where it's coming from and where y'all can avoid it in your development over there. So I'll hand the floor. That's exactly 15 minutes.
Well, Mr. McGowan, thank you very much for your presentation and for the early rising as well, as you mentioned. I believe here that we have raised hand, so let's allow Professor Konak for a comment, if I see it right.
Yes, thank you. Just 1 second on the point which was raised. I completely agree with Mr. McGowan. I didn't mention this in my keynote speech because I covered already a lot of stuff. But I wrote a recent article which I sent to Professor Anna Orak, where I discussed the fact that the EU wants to export this to other countries. And one of the conclusion is good luck with the US when you want to enforce this ESG agenda on the US. And again, it's pretty much a European stuff. When we think about it, we have to be careful. This will not go very well with the US. This is what I've said. So Anna, maybe if you can send it, this paper, which was produced 1 or 2 months ago, where I discussed explicitly this point. But okay, it was too much for a keynote speech, but I think this is a kind of, I'm almost outrageous. Usually we get stuff from the US and we complain, and now we're saying stuff to the US. Well, let's wait the reaction. So sorry, that was just kind of quick reaction to this, because I completely share the view. And at the end of the day, what I think, because we're not we're a bit stakeholder in Europe, but it depends on the jurisdiction. At the end of the day, when it will go to court, at the end of the day will be profit, in my view, and it will end up this way in almost all cases. So you have this, screen which says ESG stuff, stakeholder, but then at the end of the day, you are liable to shareholders of the company to run the business in a correct way. So I think at the end of the day, we'll get to the same result, but using, of course, a convoluted path. Yes, so thank you, and sorry for having intervened.
Thank you, Professor Konak. Mr. McGowan, any remark from your side?
No, I'll he and I are in agreement, which honestly was kind of surprising to me. I figured I was going to be the crazy American on this conversation, but I actually agreed with everything he said in that, and I'm glad we're on the same page on it. But I see there are other questions, but I'll let the other speakers go. He's eager to speak. I can see him smiling on his camera.
Yes, thank you very much, Mr. McGowan. Then we can continue with our presentation. As we see, our next speaker today is Karalampos Damelos, a lecturer at the European University Cyprus Law School. And his topic today is corporate sustainability and ESG factors in Greece and Cyprus. So please.
Good morning to all of you. I will try to share my screen. Hope you see it.
Yes, yes, we see it.
Okay. So today I will speak about corporate sustainability and ESG factors in Greece and Cyprus, compliance, laws and business practices towards a holistic approach. It is interesting that we had this presentation by Mr. McGowan, because I think it connects what I wanted to say. Actually, when we talk about ESG factors and corporate sustainability and all this stuff, I think that we are it is something new, and we see a different approach. And this approach, I think, it is a holistic approach. It is a new philosophy. Now, this approach includes political aspects, economic views, and also social responsibility. And we try to combine things. We want to have growth, but at the same time, we want to protect the environment. And we realize, at least in Europe, that this growth is based on principles, on values, and we want a green planet, and we understand that this approach is the only way for the future. Now, we know that there are different hard law and soft law instruments. I would not go into detail for the EU framework or the EU taxonomy and so forth. And I want to say a few things about the compliance in Greece and in Cyprus. As for the Greek Code of Sustainability and other laws, I will not mention the laws one by one, because I have prepared a paper on this. But I want you to know that in Greece and in Cyprus, there is a full compliance with EU laws, regulations, and directives in this context that we talk today. What I want to focus is on business practices, because I want you to see how businesses react both in Greece and Cyprus. For example, Enterprise Greece. I have here a specific paragraph by Mr. Georgios Filiopoulos, the CEO at Enterprise Greece. And he says that ESG standards have become key in business decision-making worldwide. Now, the thing is that we talked about ESG factors and corporate sustainability. Now we see someone from the business saying that it is key in business decision making. For example, how a corporate company invests, which are the factors that a corporate includes when the corporate wants to invest. And I understood, I realized that now it's not just paperwork, as Mr. McGowan said. It is about actions, not only the reporting, it is about actions about the investments. And now companies invest based also on the ESG factors. So the need to adopt ESG standards has become imperative, and there is international commitment to green, sustainable, and inclusive growth. It is not just theory, it is actions. And I say that mainly it is about how the corporates work, operate, function, but also how they decide to go on with issues of gender equality or green investments. Another example is Mytilineos, a very big company in Greece, and they say that they are proud that they are at very good performance in the ESG and Sustainable Development Criteria for 2021. And they they refer to Sustainalytics, which is one of the world's leading ESG rating agencies. Now, maybe Professor Weber has a different view, I don't know, but they say that Sustainalytics is a qualified, let's say, agency, and they rank Mytilineos second in a total of 114 companies in the industrial conglomerate category. Sustainalytics assesses companies based on their ability to manage ESG risks. Depending on the field of activity, each organization is exposed to ESG risks of different types and intensity. Mytilineos is assessed at the highest and most demanding level in 11 different ESG thematic areas, and including corporate governance, climate change, environmental management, health and safety, human rights, business ethics, and so forth. So this is what I told before, that it is actually about a holistic approach, because under this approach, everything is included, not only in theory, but also in decision making and investment of companies, and everyday work, everyday function of the companies. Another example is Motor Oil, is a very big company in Greece about oil, and they operate an ESG department. And as you see, they mention ESG, and they say, and it was, let's say, an argument that helped me, because I started researching about the holistic approach 2 years now. Now I also prepare a book. I'm the editor of a book for the holistic approach in different aspects of law, and you are welcome to contribute if you want. So they say that we, the company, implement a holistic approach to sustainable development, and at the same time with specific target goals, action plans, goal alignments, and related impacts. So it is about a holistic approach in a theoretic level, and then they have specific target and goals. Now, some details. I don't think it's useful to spend time for this. Alpha Bank and other banks in Greece grant green loans. And in Cyprus also, there's the Cyprus Investment Funds Association. How the ESG revolution, because Mr. McGowan said about it's something new. Yes, it is new, and we see here a terminology, a revolution shaping the fund industry. But it's mentioned that the trend becomes a norm, and it is amazing how fast we turn from a revolutionary thing to a norm. Of course, the European laws establish this norm. And the issue here is the ESG investing. Again, the environmental aspect, the social aspect, and the governance aspect to have a positive impact. And this is something that comes from the companies. So it is not just words, it is actions that they take. Of course, if we want to say in a few words what it is all about, it is about do the right thing. And of course, it's a lot of discussions, and I agree with Mr. Magon, it's about politics also to talk about what is right and what is wrong. But we have a new context to have a new analysis. The Sustainable Finance Disclosures Regulation is important, and the Cyprus Securities and Exchange Commission has recently reinstated in a recent announcement its commitment and focus to fostering compliance with sustainable finance standards. You also mentioned, Mr. Magon also mentioned the SEC, the Securities and Exchange Commission. The Cyprus Securities and Exchange Commission has almost the same powers. Bank of Cyprus also grants green loans. So it is about a holistic approach, not only because it's a theory, it is also the matter of emergency. It's not just a climate change thing, it is about climate crisis. So we had the COVID crisis, we had the financial crisis. Now, I think the next crisis will be climate crisis. So if we want to take measures as soon as possible, it is about emergency. So we have to see in a theoretical level how all this will work together, because it is urgent. Another thing is that the war in Ukraine, of course, also affected the way that we think in energy, green energy, and so forth. And finally, a holistic approach is about finding new solutions. This is a list of sources, and let me say in Croatian, hvala, if I spell it well.
Yes, Professor Stamoulis, thank you. Hvala to you. You spell it very good. Thank you. And thank you also for keeping up with the time schedule to all of the speakers till now. So to move on then with our next presenters, this would be Dionis Juric, Antonia Zubovic, and Edita Chulinovic-Herz, my very dear colleagues from the Department of Commercial and Company Law, University of Rijeka, Croatia. They shall present the topic, large companies saving people and the planet, reflections on the personal scope of the application of the Corporate Sustainability Due Diligence Directive. So Dionis, the floor is yours.
Thank you very much. I will try to share my screen presentation. Do you see it?
Yes, yes, it seems everything is fine.
Okay. Well, as we already heard, on 23rd February 2022, the European Commission had adopted a proposal for a directive on the corporate sustainability due diligence. And the aim of the proposal is to foster sustainable and responsible corporate behavior throughout global value chains and companies will be required to identify and, when necessary, prevent and or mitigate adverse impacts on their activities on human rights and on the environment. These new rules should bring legal certainty and a level playing field for enterprises and more transparency for consumers and investors. The proposal establishes a corporate sustainability due diligence duty to address negative human rights and environmental impacts on the EU level. In the meantime, France and Germany enacted their own national laws on corporate sustainability duties in 2017 and 2021. And the French law was actually a role model for the provisions of the proposed directive, but there are also certain differences in these national rules regarding to the rules of the directive, especially with regard to the personal scope of application of these duties and content of the duties. The new due diligence rules will apply to the large EU companies and companies in defined impact sectors and to non-EU companies active in the EU. Small and medium enterprises are not directly in the scope of this proposal, but they will be affected as a subjects of the preparing of this corporate sustainability due diligence duties as direct or indirect business partners of affected companies. Directive divide affected EU companies in two groups. The first group includes companies with more than 500 employees and on average, and which had a net worldwide turnover of more than 150 million euros in the last financial year, for which annual financial statements have been prepared. It is a general rule for large companies. On the other hand, the second group includes EU companies that do not reach the thresholds prescribed for the first group, but had more than 215 employees on average and had a net worldwide turnover of more than 40 million euros in the last financial year, for which annual financial statements have been prepared, provided that at least 50% of this net turnover was generated in one or more of the defined high impact sectors. For these companies, rule will start to apply 2 years later than for the first group, and the CSDD duties applies to the company's own operations, their subsidiaries, and direct and indirect business partners. This was criticized by academics, and it was proposed to limit these rules only with regard to direct business relationships of the company and direct business partners, due to lack of supervision and knowledge of business operations of indirect business partners of the affected company. With regard to the legal form of the company, the directive covers mostly capital companies with exception of financial entities, and concerning the calculation of the number of the employees, the directive prescribes that the number of part-time employees shall be calculated on a full-time equivalent basis, and temporary agency workers shall be included in the calculation of the number of employees in the same way as if they were workers employed directly for the same period of time by the company. On the other hand, we have non-EU companies which perform their business operations in European Union, and they are also divided in two groups. First one is for those companies which generate a net turnover of more than 150 million euros in the Union in the financial year preceding the last financial year, and second group are those companies who generate a net turnover of 40 million, but not more than 150 million in the Union in the financial year preceding the last financial year, provided that at least 50% of its net worldwide turnover was generated in one or more listed high impact sectors. The criteria used for defining the personal scope of the directive are not the same for EU and non-EU companies. For non-EU companies, net turnover threshold is used, but all of this turnover needs to be generated in the Union. Adopted solution is rationalized by the fact that it ensures a sufficient territorial connection with the European Union. And on the other hand, European companies in turn must have a prescribed net turnover generated worldwide and have to fulfill an employee criterion as well. The adopted solution is justified by non-existent methodology for calculating the number of employees in non-EU companies. Furthermore, the experience shows that in the absence of a common definition of an employee, the number of employees is difficult to calculate, which hinders the identification of which non-EU companies are covered by the scope, and with this preventing effective enforcement of the rules. Number of employees and net turnover thresholds should be calculated for each company individually and not at the group level. This raises the question of possible manipulation of thresholds by splitting activities amongst company structures. And finally, non-EU companies may leave or decide to not enter the EU market and shift their business operations into third countries with less regulatory requirements. Based on the estimation of European Commission, the directive will cover around 13,000 EU companies and about 4,000 non-EU companies. The proposed directive will probably endanger global competitiveness of EU companies and raise costs of business operations. These costs will be probably passed to the end consumers. And it is doubtful if this European legal regime will have positive effect in third countries with regard to protection of human rights and environment protection. Existing economic conditions also do not contribute to successful implementation of the directive, for instance, recession, energy crisis, and war between Russia and Ukraine. We think that we need rational and cost-effective solutions for the environment protection and battle against climate changes on global level, and such solutions should be a result of the accordance of all countries of the world. Thank you very much for your attention.
Professor Juric, thank you very much for your very informative presentation. And now we shall move to our final presentation today. And our final speakers are our dear Professor Hanna Horak, whom we all know, from the Faculty of Economics in Zagreb, and Lucia Anna Tomic, Head of the Human Resources and Regulatory Affairs at Winner Insurance WIG. Their topic today is: what is the link between duty of care, duty of loyalty, remuneration, and transition to a low carbon economy? Please, the floor is yours.
Welcome. Thank you for the introduction. I will now try to share the presentation because with the all updates, screen one, just a second. Do you see it?
Yes.
Okay, I will just, let me put it here. Okay, is it
Yes,
okay?
Yes, everything looks very fine.
Okay, one camera is here, here is there, but it's also a challenging place to be between lunch and me standing our presentation, so we'll make it, I hope, interesting. First, I would like to thank all the previous presentators because I learned a lot. This just things that ESG is a topic that basically, as previously said, holistic approach needs another word. It's even wider than the holistic approach. So even if we do it every day, there's always something to learn. So when we thought about article, what's the link between duty of care, loyalty, and remuneration? The answer is ESG, but it's such a wide answer that we will try to make it narrower for the remuneration part. In ESG, sometimes it's called this G, that I think that it's the most important one because it depends how the E and S strategies will be implemented. But it's called silent G sometimes, because in the regulatory part, it's not described very much or very often. They're mostly based on remuneration part as well. So for the reform of corporate sustainability, they're basically reforming the purpose and duties. As Professor Jelinovic-Hertz in the morning was talking about the purpose, we'll go into some details later, but it's one of the main things that it's important. What's the purpose of the company? Is this initiative part where everything implementing of this new ESG strategy comes into place. So there's the creating sustainable value. So the purpose of it is the value, and these mitigating international boundaries that we will go through a case of the Shell company, also seeing what does it mean in the legal perspective in the court. So the duties were the first one, and the most important one, in my opinion, is integrating this purpose into a business model and strategies. When we're talking about purpose, I'm also a head of the human resources. So for each company, you need people. We need people to work for the company. Today, when I'm having a job interview for a rookie, someone who's starting his business career, I am preparing myself for an interview with him. The new generations are much more aware of certain things regarding the sustainability and environment and the social impact that we want to even acknowledge about it. And today there are $30 trillion in the hands of the Z generation. So that's an enormous amount of money from the consumer side and from the employee side. Then we have mandatory due diligence as a keyword for the chain, for the directive that's also being prescribed for the duty of care. And then change into the models to shift towards the sustainable value creation. From the presentation of, good morning to Mr. Jonathan McGrowan from the United States. In Europe, we're still discussing if fiduciary duties was the duty of care, duty of loyalty, where is it prescribed? But in my opinion, they're cornerstones of the ESG. I'll mention the OECD, the new guidelines that are describing duty of care and duty of loyalty as two of the most important duties to implement the strategy, and why is it handling. So in this duty of loyalty, there's not just the shareholders, but the stakeholders perspective. And that's also what the new practice in the court, in the verdicts that we will analyze, are saying that stakeholders are becoming a part of it as well. So as we see, this is the OECD fiduciary duties definitions. So they have duty of care. And here's the source. Where is it in OECD corporate governance defined? That the board members should act in the fully informed base in the good faith with due diligence, care, and duty of loyalty, that they act in the best interest of the company and the shareholders. Probably there will be a lot of discussions about the best interest of the company and what is the best interest of the company, but also without understanding the business model and the strategy, we cannot define what's the best interest of the company. It will be probably more detailed case-by-case thing that cannot be easily put into legal framework to see what those check boxes, what do we have to define the best interest? Because it also depends on, for example, the definition of who are the shareholders. Are there pension funds? So are there long-term policy more important than the short-term? We also heard today doing the right thing. What is the right thing for the certain company? And are the shareholders, was the conflict with the shareholders and the stakeholders' interest? But the tool for that is remuneration policy, because the tool for, I don't want to say it a controlling, but making an impact on the board members by shareholders is the remuneration policies. In Croatian law, under the company law, we already have defined that all the publicly listed companies can have their board members can have yearly pay as a reward for the remuneration. In exceptional cases, 2 years pay, but then the shareholders have to decide on that. This is the tool. I call it a tool because it can be defined to make an impact on directors to see if there's conflict of interest between their interest and the interest of the company. But in the ESG model, how to find the right balance, it's probably the most difficult thing, but it's not new. There was 25 years ago, there was a triple bottom line rule developed by John Eccleston, and it was called People, Planet, Profit. Today, it's ESG factors, but basically they're covering the same side. Even then, 25 years ago, there was a potential, I would call it even a trap, that the author of this model was discussing, that the problem is that it might have been that this model will be captured by accounting and reporting standards. So this is also a danger today, that this all ESG model would end up in just nice reporting. So this is why today's model of a triple bottom line, it's in 4 bottom line model that added the purpose. Because without this purpose of a company, it will end up in just reporting standards that nobody will read, or occasionally people investing and the professional institutional investors will have to read. Last week in Vienna, there was a Peter Drucker forum, and they were discussing that today directors must be, they call them visionaries and architects. Architects of environment that people will give their best and that they will want to work in it. That's probably the most difficult thing, but in my opinion, as a practitioner, the ESG framework is one of the lately best put push for changing some things in the company. As I said, new generations are, they're different. They're very educated. They're consumers, they're employees, they will be our bosses. They want a purpose. They want something to be aligned with. One of the best practices that I've read about was the model of a company named Salesforce. It's a model named 111, and they called it the DNA of a company. So the Salesforce is an IT company from California, on the cloud company. And when they started, they set up a rule saying that 1% of the income, 1% of the working hours, and 1% of the products will go into not just charity, into some purpose that the company also supports. The purpose was also, they were supporting blind people. So when they started, they had no capital, they had no employees, and they had no products. So today, 20 years later, approximately every year, that is $30 million, 50,000 working hours, and 30,000 products that the company produces to support the purpose they're supporting. So every new coming employee during this onboarding purpose knows this DNA of a company, 1%, 1%, 1%. So if your employees and your shareholders and stakeholders are not aware of the purpose of the company, you will not implement it well. So this is a good start. If somebody didn't start, in my opinion, it's a good start to start with. So back to the legal framework, it always starts from financial industries and services sector. So this is also, it started with banks, insurances, funds. And they said that the remuneration policies had to have consent and integration of sustainable risks. Because ESG, let's not lie to each other. Environmental standards cost money. They're expensive. So it also, if we're aligning the strategy of a long-term strategy for the company, that also means that in certain cases, for example, in the next 5 years, there will be a lot of investment, and they will cost money. So basically the board of directors will not get their, when I'm talking about remuneration, I'm not talking about bonuses. Remunerations are all the benefits that company employees have as well. They will not have, because they will not meet their profit target. So the sustainable risk policies also allows stakeholders to, even if the directors and the company is not meeting their financial criteria, that remuneration policy still can be enforced, because investing today, shareholders and stakeholders will have long-term profit by investing today. Because it might happen that a certain company, if not investing today, might be closed after 2030. So this is this conflict of interest of directors, that remuneration policy is a tool for to dealing with it. In the new directive of corporate sustainability due diligence, we have directors' duty of care, but still Here, we have an act of the best interest of the company, so the duty of loyalty is mentioned, even though not specifically in the name of the article. So this best interest of the company will, in my opinion, be a challenge to define it. But with the good strategies and the good understanding of the company, that also, I have to say, from my perspective, scares me as a lawyer sometimes, that I have to come out of my comfort zone and try to understand the purpose of the business and certain products as well, to be a good lawyer supporting the purpose of it. So for the director's duties, they're like everywhere. The biggest challenge will be probably shaping the new corporate culture. Then the core values as well, so they're will be aligned with the strategy. The new component of the job description, because there are new jobs coming. Employees' jobs are changing. And what do we have to do? We have to educate them. We have to educate them on the new things coming, on the purpose, on the new strategies. Because if our employees, our shareholders do not understand the company, they cannot get aligned with it. And how to do that with also key performance indicators as well. So the advanced companies already have one of the ESG factors into key performance indicators for the directors in their field of expertise. So the governance guidelines of the EFRAG, as today's already mentioned, they were delivered drafts. They were but on Tuesday, on the 23rd of November, I think they were sent to European Commission. So we have governance guidelines, the roles and responsibilities. Then we have also information based on the previous slide on the both of these are education of shareholders. Sustainability matters addressed by undertaking of the supervisory bodies, and integrating the sustainability strategies. So the starting point would be also for directors and the board members to define in their strategies, because in Croatia, we always do things the last minute. I'm the best example of that. So this legislations spreads up next 8 years, but the strategy needs to be implemented now, because if the roots are so deep in certain changes that we cannot do it in 6 years or a year ahead. And also the statement of the due diligence. Also the new guidelines of the EFRAG regarding the business conduct were also brought up to the European Commission. In there defining the corporate culture, the ABC policies, as we call them, anti-bribery and corruption, the relations with the suppliers, the payment practices and the tax practices as well. And also the political financing the political parties and lobbying. And this is one of the examples how you cannot define best interest and the strategy without knowing the business. For example, in oil and energy sector, the top target for the board of directors is how will they implement financing the political parties and lobbying. Because the purpose of the whole thing is that the whole industry is dependent on the state of the decisions of the oil drilling and pipelining So this is, they want to be more transparent because they depend much on the state's decision. So when we're talking about a mindset, I want to say that it's not, these things are not very new, but they're making a new framework. So what's the mindset basically? It's change the mindset. It's extremely difficult, but we all see here the toothpaste. It's where it should be. It's a small, it's white, green. But what about this one? A lot of the ESG factors are here years before, but we just didn't spot it. We have to put it out and put it in the core of the purpose or the company, because that's the mindset, what separates the best from the rest. Changing the mindset in legal environment is difficult, because my first exam was the Roman law, so it didn't change much in 2000 years, and now the things are changing very quickly. But in the last year in Europe, there were 18 verdicts or court proceedings, some of them are not final, that are changing completely the mindset of this topic. So I will mention two of them. They're game changers. All 18 of them, we'll see how they will end up at the end. But the first one was the damage claim by Raul Lula. He's a Peruvian farmer, and he filed a suit against a German utility company. When I'm talking about damage claim, there's nothing here is at the moment in this court proceeding connected to the ESG regulations. Damage claims becomes more it's an old part of the law, so it's just making a new framework, this mindset that they can even put it through. So he filed a lawsuit in Essen, he's from Peru, that is a headquarter of the RWE company. And the reason is that the energy company contributes to emission that threaten his family, his entire community in the city, because the glaciers were melting and they were causing landslides. As RWE contributes to 0.5 global emissions, he requested the 0.5 damages were requested as well. So the first instance court denied the lawsuit, but the second one considered that Peruvian farmer was right, that his claim was justified, and it still remains to be determined how the damage was affected and how to which extent it will be done. Even if it's 1%, even if it's €1, it's a principle that it's changing. In a couple of years, maybe the amounts will be higher. Then we have Royal Dutch Shell Company. There's a judgment of the court a year ago. The company committed to reduce emissions by 45%. Legal source was the Paris Agreement on Climate Change and UN and OECD guidelines. The legal ground was duty of care to prevent damage and to respect human rights. And lawsuit was filed by a shareholder that was an NGO Client Earth organization that he claimed that 13 of the directors are personally responsible for failing to align the strategy with the Paris Agreement. And what is interesting, that the company is also considered responsible for actions outside the Netherlands, where the headquarters is, and the consequences of the products are wider than the Netherlands. And the company is currently not violating any laws, but they gave a deadline that by the 2030, the court considers that behavior is illegal and that it contradicts with the social expectations. So just for the end, this is one of the best practices in examples of the corporate governance. It's a reporting standard. It's short. It doesn't have to be long because nobody reads it. It has to be clear. But here, the Ørsted, the Danish company, for the governance, to comply, to fulfill all the requests, they have the governance model, board of directors, executive committee, supplier due diligence, and the whistleblowing cases. That means these ABC A-lines policies. The corporate governance model has to be clear to see who is reporting to whom and how. And these are the next three. For the most interesting here, this supplier due diligence chain. It can be the whole presentation about that, so I will not have time to go into details today. But here, they report on all the things they do by making a due diligence on their supply chain and to see if there's any breach of law in their value chain, because that's not supporting their values of the companies. So even though these companies are obliged to do that if they're publicly listed or the big ones, the SME companies will also be affected because they will be due diligenced, I'll put it that way, by bigger company if they want to work with them as well. So in my opinion, for the last, as they say, the moment you take responsibilities for everything in your life is the moment you change anything in your life. So in my opinion, the ESG is a great chance to admit that we did something bad before, but with a new ethical approach, start a new, well, let's put it a decade of the history. So thank you for attention. Okay.
Thank you very much for your presentation, Ms. Tomic, and for wrapping up so nicely this part with the presentations. I must admit, I think this is one of the best time-framed sessions I was ever present, but this is also probably due that we have one presentation less than planned. Now, after all of these presentations, perhaps my comment would be that directors' liability is even a starker question, and the issue whether they can somehow limit their personal liability is probably going to be one of the issues that shall be further elaborated, at least in practice and scholarship, of course. Now, as to our second part, the discussion, we saw some questions in chats during the presentations, and there were two questions from Corrado Malberti to Mr. McGowan, and as it seems, I think that Mr. McGowan has properly answered these questions. However, Professor Shofranko actually started a very interesting discussion, which I believe should be further addressed. He posed a question stating that, and this is the question is posed to Mr. McGowan and Professor Konak. If the EU insists on a stakeholder approach while other jurisdictions like the US stick with the shareholder philosophy, could that have a negative effect on the EU economy in the end? I see it as a potential gateway to new race to the bottom effect. Investors could be attracted to jurisdictions that are more in favor to them and less towards social and environmental framework. As I see, Professor Konak shared actually a document with us, an article. So perhaps Professor Konak, would you like to start with the comments if there is something that you would like to add? Or not? Then we see here Mr. McGowan, if you would like to comment something on this question.
Well, I think there is always a risk that you overregulate yourself out of being competitive. I think one of the, I'm not sure if it's necessarily a shareholder versus stakeholder comment. I'm not, the considerations aren't necessarily new in the EU. The member states have operated under this under some capacity. But I think that is part of the concern with what you keep tagging on as a stakeholder. And the broader you make it, the more you start cutting away profits, and then your outside investors. But then also consider how many of your companies are actually crossing outside the EU as well. And that's a factor to consider. It could drive up cost, but it would definitely have an impact on the transnational corporations, I would think.
Okay. Perhaps if I can also ask Mr. McGovern, it's under your opinion, will US companies be willing to actually involve the ESG in the corporate governance? Do you think that such a movement actually is possible? Will it happen? Or the major opinion is actually leave it out if you can?
Well, that gets into public opinion. When you're looking at it, you're looking at how does the consumer impact the use of these products? How does public perception, and which also gets you back into the greenwashing debate, like why, where they're not spending, they're acting like they're doing something, but they're not really doing it. And that gets you, it opens up another dialogue over if a director is responding to public demand by doing something that's environmentally friendly, and in the turn that makes Ms. Weber really wants to say something. I can see her chomping at the bit up there. But if you can justify it and say, look, if we do something that's environmentally friendly and it makes us look better and it gets us more money, there's your back way through. But the comment earlier about, is this a fad or is this a permanent thing? How much do you incorporate into your permanent corporate governance documents, and how much do you do as part of just a marketing thing? But I'll pass it off because I know she really wants to say something.
Professor Weber, the floor is yours.
Yes, thank you very much. I wanted to shortly comment on the question Professor Safranco asked, specifically about that fragment, whether this will be bad for the European economy if we pursue these goals in that vivid manner as the EU is. So I would like to respond with maybe a controversial phrase, but that is that fits very much the phrasing of these problems that I see with several NGOs that I observe, and I think it kind of gives a broader perspective and encourages us to look a little bit broader on that problem than only from our narrow corporate law, business law, and business perspective. So, which is the phrase, I mean, no economy on a dead planet, right? And of course, you may think this is, some phrase and maybe controversial, but the thing is that we, and in this discussion also, we very much focus on a very, very narrow, let's say, perspective of basically these states that generate the whole problem of climate change. While we, and this is probably, it's very well framed in these two tragedies. One is the tragedy of the commons and the other is the tragedy of the horizon. And both of them apply to the problem of climate change. So we have like one planet that we use together. And the problem with climate change is that we tend not, to see it so much because everything that happens in Europe or the United States is maybe a little bit more rain or, drier periods. But basically it's the populations of the sub-Saharan region and other populations that are feeling the results of climate change. So this is one problem for policymakers, and I think especially policymakers in the US, that it really doesn't matter to US citizens what the effects of climate change are now, right? So this is one problem. The other problem is the tragedy of the horizon. So this is a problem that is visible in all political economy theories. The actions that politicians take now, they will be probably, their effects will be visible in a few years after they're out of office and not even candidating for other rounds. So I would just like to, I know this is a very broad discussion, and the topic of climate change raises like very strong feelings in different people from different parts also of the political spectrum. But I think that, we have to embed this discussion. This is my last sentence. We also tend to, and this has been repeated, that the stakeholder shareholder debate, that this is not a new thing, that we had the discussion in the 70s and so on. It actually is a very new thing, because if we would only discuss our values and our ideas of how a company should work and whom it should serve, then it wouldn't be a problem. I wouldn't have a problem with that. The US wants to further pursue their stance in shareholder primacy. But since the 70s, our factual background that is proven by the natural sciences has changed so much. We're not in the same situation as Friedman in the 70s to like freely discuss what we can do in business and what we can do. It's not so much an ideological question anymore. We have certain natural constraints that frame this discussion. And I think that also as, company law, business law scholars, we cannot be ignorant of that frame that the natural sciences is, signaling us to ignore it. So this is more of a general comment, but I felt like I had to address these worries about the European economy. Thank you.
Thank you, Professor Weber. Professor Shafranko, would you like to add something to this discussion, as you are the one who started the one?
Yes, sure. Thank you for answers. Well, I agree with Professor Weber in every sentence she said. We don't have the opportunity to think about whether the climate changes are coming or not. They are already here. But my question was focused on one thing. I see this as European Union, if they persist with the stakeholder point of view, could lose everything and get nothing. Because the climate change, the European Union is not the only generator of carbon and climate changes, okay? So it depends strongly on other jurisdictions such as USA, China, India. And so if everyone does not stick to this problem, we will get nowhere, I think. Well, that would be my comment. Thank you.
Well, thank you, Professor Shafranko. Does anyone else want to comment on the current debate? No. Well, perhaps
If
then,
I
yeah.
may raise
Professor
the
Horak,
hand.
please.
Yes, I would just like to add to what Anne-Marie said. I think, as I said in my in the opening session, well, I think this stakeholder issue is a sort of a trap, because if we look at the stakeholders, I think including stakeholder is not a problem. This is a social norm, I would say. So externalities are important, and they are for sure influencing today's requirements and needs. And if we look exactly at the sustainability. And I think what is important, company law didn't change and didn't define interest of the company during the years. So from 1970s, last century until now. And as we have seen and we have spoke today, there are numerous changes. So it should be seen probably from our presentation. I think this is a good approach, this 4 Ps. I think that the truth is somewhere in the middle, not to leave behind everything what is company law, and for especially here in the Europe what has been seen, but of course to adapt and to find a way forward. I don't know if I have understood correctly, but I was looking in the French law de vigilance, which is a little bit different than the German approach in their law. So as I understood correctly, they are putting, I would say, the new topic is mission and vision of the company. So the mission and vision of the company usually was, let's say, an empty space where you put some wordings that will satisfy the general idea. But probably if we now need the path to define what is the interest that directors serve, we should maybe start from the vision and mission of the company, because from there starts also strategy that directors need to follow. So thank you. I just wanted to add that.
Thank you very much, Professor Horak. Well, stemming out from the last presentation we heard from Ms. Tomic, she actually said what I heard from many of you speakers, is that unfortunately many good new or old but new ideas are in danger of actually ending only as a reporting duty. And regarding these reporting duties, and then what follows up with, as Professor Weber stated, that we created a new market for new providers, regarding the auditing, but it seems to me that these new market players are actually gaining pretty big importance in this field. Now, Professor Weber also touched upon that. We heard from Professor Stamelos also that these new providers have an important role. Well, could I perhaps invite you for some thoughts on, is there any way that we avoid that everything ends up in reporting and formulas and some auditing agencies, with perhaps losing our good primary goals, which we all mentioned here? Any remark?
Who was that?
Professor Weber?
Yes, so as I have raised the topic of the emergence of, and you know, the new gatekeeper, I mean, of course, the whole problem is to strike a balance between formulating some standards, because what we've seen from the current regime is that if we don't have a certain level of unified standards, the regulation itself becomes very ineffective, because we cannot even compare what the companies report if we don't have like a certain form of doing it. So this must be one consideration. But on the other hand, and we know it, that the EU has this tendency of overinflating regulation and making it very granular. So I haven't had a chance to look at the new EFRAG standards very carefully, since they they only had this one version, preliminary version circulated yesterday. They submitted it to the Commission, so I don't think that they're published yet. But from what I know about the whole concept of structuring these standards, this is going to be super complicated. So we're going to have like one standard for all the companies, and then they are going to work for the next year on standards for different branches of the company's functions. So of course, this is the main challenge for the EU lawmaker, to strike a balance between some sort of standard and standardization that is needed to make the reporting just comparable and accessible to investors. But on the other hand, like not over complicate, and still not make it like a whole philosophy of filling out the forms and so on. So you're absolutely right in seeing that, pointing out that danger that comes with these regulations.
Thank you, Professor Weber. Do we have any other comments?
I'll just weigh in on that real quick, but my background before I went into law was actually I owned businesses. And that is what you're touching on is really part of is going to be the big issue as you're moving forward, is how, are you just putting paperwork on somebody, and are they going to be able to find a way around it? But also, are they not going to understand it? And when you're talking about the fiduciary duty, it's key that the corporate directors, and if you're putting it on SMEs, that the owners understand, and it's put at a level that they can operate in, and it's tangible. And we're a room of 128 people that really know what we're talking about, and we still don't quite know what we're talking about yet. And that becomes a problem when you're dealing with the average business owner and the average person, and somebody who has to look at this. I mean, don't get me wrong, I'll make good money on it. I'll charge these people good money to do that for them, but maybe that's going to be the problem moving forward. I can't do it all.
Okay, thank you, Mr. McGowan, once again. Okay, now since we are coming to the closure of the session, are there any final remarks from any of the participants, from the guests? To me, it seems that all was said, what was intended. Well, I really want to thank you for most interesting presentations to all of you presenters. Also, I'm very glad that we touched upon these issues in our discussion. The feel at the end of this entire session for me is quite positive. It seems that all of us wish to and aim towards positive thinking, toward positive governance in corporate governance, and these are the goals on which we always have to work and strive towards. So thank you very much, and I wish all of you a very successful rest of the day and of the conference, of course. Goodbye.
Bye.
I see you at 1:15.